What's up, guys? Wanted to share with you guys today where is the opportunity that you should be looking for if you're looking to multiply millions of dollars, your money, your partner's money, invest with other people in multifamily real estate. And that's the huge question, right? Like right now, I think they're talking to Bill Ackman right now on CNBC. Naturally, he's a multi-billionaire, really got his start and or known for other things with Pershing Square, I think it is. Yeah, Pershing right now they're getting ready to buy out a pretty big company that which is Howard Hughes Holding, which is real estate. Anyways, the whole part about that is this. There's a lot of uncertainty in the market. So where should you focus your brain where you're going to invest your money? Let's say you got money in a 401k IRA, you got money cash and savings, you got equity in a home, you're thinking about selling it, what should I do with it? Or you got money in Fidelity, Vanguard, wherever, right? Like you know that you have to move your money to continue to grow. 2 weeks ago, the stock market lost $6 trillion. It was down. I think it was down like 3% of the market. Like that's huge, right? So if you had $1 million in the stock market, you would have lost 30 grand for the year. Or if you had $100,000, you would have lost $3,000. While that doesn't seem like a lot of money, dude, you lost money, period. Warren Buffett. Matter of fact, I think last week he announced that they were going to be changing CEOs. They were going to be moving to another CEO coming up here soon. He's putting that in. He's the oracle. He is the number one investor on the planet. And what is his number one rule for investment of money? Of money. Don't lose money. I got choked up just talking about him. But anyways, the point is this. Where should you focus your opportunities? All right. So I like to tell people right now, like this is going to be huge. So the number one area you should focus if you're looking for opportunities in this market is not the what, it's the who. Who is having challenges right now? We all know from a real estate perspective, your goal is to look for these opportunities for people who have to sell, have to exit their opportunities, right? So, like for Bell Capital, we look for fund managers and syndicators who are at the end of their fund cycle and they have to exit the deal. I said they got in 5 years ago. They bought in 2018. Now they have to either one, they got to refinance their assets, recapitalize, pay their investors back. Their investors are not me and you. Their investors are CalPERS, Guardian Life. Their investors are J.P. Morgan. Their investors are Goldman Sachs. Their investors are big institutional banks, the elite. They're not us. They have to sell. It is time to give those people their money back. So when I'm looking at a deal, I'm like talking to brokers and I'm like, what is the reason why they're coming to market? Why now? Now is not the best time to exit, right? And they'll say, hey, their debt's up. They have a loan maturing right now, so they're coming to market today. Like they have 3 months, 6 months left, 4 months left on their debt. They got to come to market. They're exiting the market now. That's an opportunity. That's a who opportunity, not a what opportunity. It's not the property. You can look at better assets now when you couldn't do it before. Like I could never get access to these deals before. I didn't know the brokers, didn't know the assets, didn't know the players. Now these players are strangled out. They have to come to market and sell, or they got to refinance and take some loss, right? So there's the opportunity there. It's not what, it's who, or it's who, not what. So if you're looking to invest money, you want to invest money in a higher quality deal right now because the higher quality players, the big players, the institutional banks, the institutional investors, they're the ones who are in this crunch right now. It's not the mom and pops. The mom and pops are feeling the pinch, but they're not in a crunch. That's a huge difference. So our opportunity is really sitting up on the top of this correction, right? There's a capital correction. There's $2 trillion worth of commercial debt. That's why this guy's getting in it. Bill Ackman, before they used to call them like corporate raiders, but technically they call themselves activists, meaning they buy companies and activate profit margin. So like never before has this opportunity presented itself for guys like myself and women like yourself. If you're a woman, like these are the opportunities in the marketplace we can capitalize on because who is going through this correction is more important than what is happening in the marketplace. But if you were going to look at the what, $2 trillion worth of debt maturing right now over this next few years, which means 2025, 2026, 2027, and oh, by the way, just stated 2028 is on the chopping block for a lot of new things coming. So with these big companies, Blackstone, Goldman Sachs, J.P. Morgan, some of these other bigger players out there, if their assets are changing hands currently right now, that's never happened. They didn't have to do that. If they have to change hands, that is the wealth transfer that everyone's talking about. It's not your grandma leaving you some property or your grandpa leaving you property. It is the wealthiest of the wealthy now needing to transfer those assets that normally were never going to be available. And we can jump together collectively to be able to do that if we were to come together and do it. Most people are, oh, I got to own my own deal, Vic. I don't want to invest money. I got to have it myself because your grandma, your grandpa, your mom, and your dad told you don't partner with people. Partners are bad. They're going to screw you over. That is not true. The problem with partners is you don't have enough partners. You need 100 partners on a deal. That protects your capital. You don't need one or two, right? So anyways, don't get me on a tangent on that because I like that is huge. That was the biggest mistake I've had in my life. Not enough partners in a deal, which means you got to go bigger. The pie has to be big enough to be carved up to feed everybody, right? I want to make me and my investors money, not just me, or not just me and one person. Like that doesn't work. Anyways, here's the other thing, which is the uncertainty, right? That with the debt coming due, that's happening. And then you have the tariffs, which is causing a lot of uncertainty, right? Here's the deal. The cost of goods, the cost of materials for a real estate, the steels, the stone, the brick, the glass, the concrete, all of the things, and the labor, the people who have to be paid for this stuff. It has to be shipped over here. There's a cost associated with those things. Cost, which means that as cost of those things come up, supply is going to come down because they're not going to build as much, right? And I'm excited about this today because I really, really want you guys to understand this. Whether you do it with me or you do it by yourself, doesn't matter. This is the opportunity, this market opportunity, this correction that's happening with the tariffs causing uncertainty, causing people to pull back. Builders don't want to build, lenders don't want to lend on new builds, which means that if you have an existing asset, if you can get a hold of an existing asset, that the time is up, they have to trade it, whether to you or somebody else, doesn't matter, right? That is an opportunity. That's a very simple economic driver of supply and demand. What's it called? Like disjointed supply and demand. Not enough supply, a lot of demand. Everybody's gunning for the same thing. And here's the other piece. And I talk about this in the other video where I talk about barriers to entry. If a deal is too big for everyone to touch, you got to collectively come together. That's a barrier. That means everybody has to come together to do it, which is why we did Bell Capital, right? So that's another piece of uncertainty is the tariffs are causing people to pull back. It's causing this uncertainty. Nobody wants to spend. Nobody wants to make that bet, even though the bet on real estate is safe. All right. So between the $2 trillion, the tariff uncertainty was making people pull back. The limited supply and supply coming to market over the next 3-4 years for building, and my folder keeps falling. That's another uncertainty thing, or an opportunity for me to fix it. The other thing on this, which to me that's also exciting, is the tax piece. Because if you take a look at what's happening right now, Trump, I think they did it last week. He was putting in a bill to make sure that the accelerated depreciation comes back, which means that the more money you make, the more money you keep, right? Because before it was the more money you make, the more money they take. Now, if you're an investor and the more money you make, the more money you're able to keep. Now you can have more money so you can continue to invest and create wealth for yourself and your family and give money to your church on the things that you care about, sustainability for life, all of those things. It's important. But those things are a part of this uncertainty that's happening right now, right? Because if that happens, a lot of people are going to dump a lot more money back into real estate, which does what to the value, spikes it all up. So if you're in over this time where you can take advantage of it, you're good, right? So, like I said, if you have money sitting in a cash, you got money sitting in a 401k IRA, you should be looking at moving your money to invest in cash flow, multifamily real estate, institutional grade, great quality assets. As certain certainty happens, you want to raise your level of quality, which solves the uncertainty problem. If you're not certain because it's a bad asset, if you get a nicer one, the certainty goes up, right? And you couple that up with the uncertainty with just players in the market where there's less people out there doing the game. That adds value. So with those things, I wanted to kind of go over something, and this is kind of, and I wrote this down because these are the things you need to be looking for, right? So, and I just went over one of them. Number one, you need to be able to move your money to a higher quality asset, but you want to move it into something real, right? Stocks went down as of late. They'll go up as of late. I think they were saying this was it was like it broke a 9 day winning streak, which had never been done before in like years, which is crazy to me. Because if you lost money last 9 days prior to that, then all of a sudden they're celebrating this 9 day winning streak. It's like, what does that even mean? If you put in 100,000, you lost $100,000 and went to zero, you need to make $200,000 because your first $100,000 was yours. You didn't make $100,000. You got to get corrected. And in order for you to do that, man, you got to move your money into something that's more quality, and it needs to be real. Get out of the stock market, man. Get out of the Wall Street casino. It's crazy. I just don't play it. Like I'm biased. I love real estate. I'm going to push for real estate. So I'm going to push my investors to do that. So next, you want to be in something long term. Yeah, I have long term there. Like when I say long term, I'm not talking about 12 months. I'm not talking about 2 years. I'm not talking about 3 years. I'm talking about 5 years, 7 years, 10 years. To be in something long term, really 10 years is long term. 7 years is long term. And then stay in that deal for a lifetime if you have to. Like you need to be a long term player. This is a marriage. Like I'm married to Sharon. I'm going to be married to Sharon until we die. Hands down, period. Because I think long term, because I know all winners are long term. We just talked about Warren Buffett retiring. Warren Buffett's like 90 something years old. Charlie Munger was 98 years old, or however they were. They were long term players. They were still doing the same thing in the same companies over the same periods of time, long term. So if you can think like that, you have more chances to win and you can defeat any uncertainty in the economic market, in your life, the people around you, death, all of it can be overcome if you're a long-term player, right? So, yes, you want to move your money into something real. That's number one. And number two, you want to be thinking long-term with your investments. That changes things when you think about what you're going to invest in. Higher quality deals, and you're going to be in there 10, 20 years, and then maybe refinance your capital out, get your money back, which is what we plan to do with our investors, and then stay in those deals for another 10, 20, 30 years. That's generational, right? Like we have a 100-year plan here. So the next thing you want to do with your money is you want to protect capital. Number one rule of all investments, do not lose money. Do not lose money. Number two rule, don't forget rule number one. Real estate itself, like great pieces of real estate, great locations, number one, great locations, number one, great piece of real estate, number two, like it preserves your money. If your money's sitting in a bank account right now, it's losing value, even though it still says $100 bill, $100 on it, or when you look at your balance sheet, it still says 100,000, 200,000, $25,000 in your savings account. That $25,000 buys you less, probably about 25 to 30% less of what it used to. It's already lost $6,000 worth of value, right? $6,000 of its buying power if you were to pull it out and use it today. That is happening whether you want to or not. So you want to move your money someplace to one, a real asset, two, long term, and three, something that preserves capital, meaning that if it's real estate, it goes up in value. Why? Because it's scarce. If we buy a 300 unit apartment building or a 200 unit apartment building in a great location, no one else is going to do that. That location is going to be there. As a matter of fact, if we put 10-year debt on it, we can't sell it for 10 years or we get penalized. That's how that works. So you want to be able to protect capital, right? Next, you want to be able to leverage your money. So let's say you were to put 100,000 into it. 100,000 in a great piece of real estate buys you a $300,000 position with good leverage. Your money is worth more money outside of cash. So if you take your cash, put it into a real asset that has value, then you are leveraging your cash to buy a real asset that is worth more than your money. That's what you want to do that way. You're looking at these opportunities, the who, not the what. But then as you move into the what do you need to be doing? And we're talking about investing money, investing capital, right? Next, you want to be able to invest your money in something that does cash flow. The king of all kings is not cash, it's cash flow, something that pays you a little drip while you wait. It doesn't need to be hundreds of thousands of dollars a month, but it does need to pay you. It needs to pay for itself and give you a little bit to keep you not from to keep you from starving to death, right? Especially if you're going to be in it long term, right? The next thing is always going to be outside of your cash. So you want to have something that appreciates, it goes up in value over time, which is why you got to do it long term. Because if you're not pushing on it every day, it's a passive investment for you. You throw your money into an apartment building deal, somebody else is pushing on it. Me and my team, we have third party property managers. We're going to push on them, and you get this drip every month. And then while that drip is happening, we're raising the income of the asset, and the asset is appreciating in value. We can control that just based on, which is also on my list, based on just natural inflation. If you're an investor, if you have money in real assets, you want inflation, right? Because that's on here. You want inflation to drive the cost of goods, real assets. You want it to drive the values up because your money is in there, and because your money is just wait, you get a natural lift on your money if you're a passive investor, right? So you want that happening with your cash flow. Next, you want it to be an illiquid investment. Most people want to be liquid. They're like, oh, I want to be able to touch my money. I want to be able to press a button and have it go back to my account. Wrong. That's not a good investment. You want your investment to be in something that's illiquid. You can't get after it. So if there's an emergency, there's something that happens, you got to push back out and go put energy into your business, your job. You got to get down and work. You have to tell people no. right? If your family member comes and goes, "Hey man, what's going on?" Blah, blah, you have to be like, "Hey man, I can't. I have to focus on what I'm doing right now because I don't have any money. My money is locked up in an investment that I can't get out." That is illiquid. Let me tell you, the people who did that will continue to accelerate their world because number one, the people who do that are way more creative. You have to get your head wrapped around, I can't get my money. I got to go out and produce. Whether it's producing my business, produce at my job, produce at whatever I do, go and show up and go help somebody else, whatever that is. But your illiquid investment is a benefit to you not being liquid. Because when you're liquid, you can press a button, escape it, and you lose value on that money because you lose time. All right. So the next thing is I talked about this was it's real estate as an investment to be able to put your money into an investment asset like real estate. It's an inflation hedge. The dollar has went down 86% in value in my lifetime. I'm 51. I'll be 52 this year. Since 1973, it's went down 51%. It went down 20% just in 2020 when the Fed said, hey, they started raising interest rates. All the other stuff happened. That stuff happened. Money got printed during that time during COVID. All of these things happened to your money. So the cost of everything inflated. Everyone's talking about eggs and cars and the cost of homes. That's an inflationary cost. So if you have a certain amount of money, like I said, you have $25,000, you lost $6,000 or more of its buying power. How do you fix that? You take your 25,000, 100,000, 200, $1 million, and you invest it in a real estate deal that gets a lift from the inflationary cost. And then your money keeps up with inflation. If you keep it in the bank, let's say you're in the bank right now, your money may be making 4%. Let's say 4% if you're a big roller, but let's say on the average, on the average savings account, there's $11 trillion in American savings collectively right now. And I just looked that up the other day. You can Google that number, $11 trillion in American savings, in savings account in America. You're probably only getting 0.025%, a quarter of a percent on your money. So it's not keeping up with inflation. If inflation is at 2.6 or 2.8 or 2 or 3%, which is what the feds are trying to regulate right now. If it's at 3 and you're only getting a quarter of a percent on your money, you're not even keeping up with inflation. If you're getting 4%, I'm going to give you guys this math. If you're getting 4% on your money from savings and inflation rate's at 3 on the average, when you exit the 4% money, the money gain that you got, you're going to have to pay earned income or ordinary taxes on that, or it comes to you as ordinary income or ordinary whatever, what earned income or ordinary income. You're going to get taxed at 40% depending on where you're at. So you're not even getting 4, you're probably getting like 2. And if the inflation rate is at 3 or 2.8, you're still not keeping up with inflation. Even though you had this gain, you got to pay taxes on the gain. You're not keeping up with inflation. And oh, by the way, you had to pay taxes on it, which comes to you and it may hit you up, put you in a higher tax bracket. You don't know, depending on what state you're in, it could be 55%. Anyways, follow me on that, man. That's important for you guys to know. Money is not just money. Money is a flowing movement, and the more money you make, your goal is to keep more of it. Now, that money was in a real estate deal, and you were getting the tax benefits, the tax advantages, which is coming up next, which you want to be in. The tax write-offs, the depreciation, the debt buy down, which is another form of tax benefits because if it's buying down the debt, you're getting equity growth, and then all of a sudden you also get to write off those mortgage payments that gets passed on to our investors as well, like the interest on those mortgages because you get to write that off. Like all of these things are to your benefit, right? Most people don't think through this when you're making an investment. You're just like, oh, I invested in a deal. There's so much more because now we're not talking about the real estate, we're talking about money. And when you understand the flow of money and how the wealthy play the wealth game, you really run through this list very differently. All right. So the next one, I just went through the taxes. I went through the debt buy down. You have the other thing about where you want your money to be, especially for real estate, is that you aren't paying the debt down. Your residents and the asset are paying the debt down. The tenants are paying it down. The tenants are paying the taxes. We talk about insurance costs going up. We talk about taxes going up. We talk about the cost of goods and energy and running the property and paying for employees and paying for staff members. Who's paying for all that? The tenants are paying for it. The tenants are paying the debt, not you. So when you invest your money in there, the money that you're getting back is coming from somebody else. So that's valuable because now you have leverage. Like we talked about, $1 buys $3, but you also have the leverage of you not doing it. It is a passive investment and it continues to grow, keep up with all these other things that you don't have to worry about. You could just make the right investment and keep on expanding your own personal income, business revenue, showing up and doing the things that you got to do for you, your family, your charity, your church, all of those things. That's why investing is so good. All right. So, and last but not least, you have your exits. You need multiple exits. You want to know, hey, look, if I make an investment, let's say you make an investment with Bell Capital, right? The way that my structure, my target is always, hey, get in the deal, increase the income of the property, that which increases the value of the asset. Go back to my lender and say, hey guys, look, here's the new NOI on this property. We want to refinance and we want to pull out capital. We want to pull out, recapitalize our investors. That's what we plan on doing. I get that money, I distribute it back to you guys. That is a non-taxable event. Then I keep you in the deal, and the income of that property that still pays for the debt, like we said, by the tenants and residents, good management, great location, that still happens. So now you get more cash flow as you wait. And then we continue to raise the rents on that asset because it's in a good location. That's the goal. And then later go back to the debt market if we can, and we go, hey, we want to do it all over again. And I'm going to distribute it back to you guys. And you get the tax benefit. And that's a non-taxable event again. So you probably got your money back. Now you got this big surge of money coming back, non-taxable. You got cash flow, and we kicked over the tax benefits of accelerated depreciation back to you. You get that on the K1 because you are a partner. You get to take benefits of a partner, and you get to also write off the cash flow you got, and maybe even take and pass that over into some other expenses that you have, to write off some other income that you have, because there's other ways to kind of get this done. You could be like, hey, I can file as a professional a real estate person. So now I get to offset some of my other business cost, my business income based on these benefits of this thing. So you got to have these exits of saying, hey, let's refinance, cash out, or maybe I can take our whole portfolio later and I can bundle it all up and sell it and rip somebody's head off. I want to take our portfolio to another institution and buy. So they're not going to buy one property. They're going to buy a portfolio of assets. So we got to put together a great portfolio of assets that are the greatest assets that they can also get their hand on, like a collection, and then do it to them. Or we do it and we seed a REIT. I turn it all into a REIT, and then we go public with this. Or like we said, we take the whole bundle and we get a big portfolio loan, and then we refinance. I give all my investors their capital back, and we sit on this deal and we continue to expand the portfolio, and we start putting other things on top of it, like one of my mentors is doing with the Bitcoin fund. Right? That's one of my goals to do later because I think that's going to be valuable to do. So, anyways, this is why you have to have your investments in something that you have multiple exits. Because if your only way out is to sell, then you lose your investments. Once you sell, you exit that investment, you're no longer invested in it. Period. That's how it works. You may have got your gain that you have to pay taxes on, but you're done. So this is a little bit longer video because I wanted to share with you where are the opportunities. So to move away from the where are the opportunities to focus on where are the opportunities, you got to look at who are the opportunities. Who right now is struggling in this marketplace? They can't move. Big institutions, big institutional banks and players right now, man, they're not pulling the trigger on stuff. If they are, they're trying to steal stuff, and it's hard to steal stuff at that level. If you're stealing it, you're buying it below replacement costs, but the property is still performing great. And you got to have capital, you got to know somebody, and you got to know what you're doing. So if you're in that situation, you want to invest with us, please, love to talk to you guys. Go to bell-capital.com. You can hit get started. You can check a look at the fund, take a look at our open fund, what we're working on, how we're working on it, get added to our list. We'll share with you the deals we're working, or you can schedule a call. Myself or somebody on my team will get with you. We can talk about your situation, how to get started, how we can help you, point you in the right direction if you want that. That would be great. Or you can go ahead, you can get our real estate book. You go to bell-capital.com/book. That's bell-capital.com/book. You can get our real estate book. If you want to do this yourself, man, I'm here to help you. That's why I make these videos. Why I do what I do. I just share it with you. Make wealth your duty. Wealth is my duty. My job is to help my family, my friends, people I care about, my network continue to create wealth for you and your family so I can take care of my family, my kids, my grandkids, my church, the charities that I care about, the things that I want to be involved in. And then later when I die, leave something great, man. Build a huge organization with a bunch of people that continue on building this company without me so I can help more people while I'm alive and while I'm dead. I hope you're doing that too. But that's why I do this. I do this because I want to help people. I've always wanted to help people be successful. So I'm here for you with this. So where's the opportunity? It's the who, not the what or the how. Don't worry about how you're going to do it. If you have money, you need to invest money, right? The easiest way to become an investor is to invest. People are like, how do I become accredited? Invest. Invest your way. Everyone started off non-accredited. Warren Buffett started off non-accredited. Bill Ackman, who was on here, started off non-accredited. He's on there now. All these guys are non-accredited when they started, right? So you get started. How do you get started? Become an investor. The easiest way to become an investor is to invest money. That's how you start building wealth. Focus on generating revenue. Don't lose any of it. Put it in a place where you can start stacking cash, and then take when you finally hit a couple, 25,000, 50,000, 100,000, park your money, right? Hit us up, partner with somebody else, whatever that is. I'm here for you, but we can do this, right? So, who's that? We were just talking about Warren Buffett, right? Because these guys are getting out of there. Like I said, this is a preview from yesterday. They're talking about it. But you guys have a great day today. Like this video, comment on the video. Give it a thumbs up or give it a thumbs down. Don't be a hater and a hider at the same time. Whatever it is, I want it, man. Leave it in the comments. What did you get from this? This was a lot today. This was a lot today, but I came here because I wanted to share this with you. What you need to be focused on. Where is the opportunity you need to focus on if you're looking to multiply money, multiply your investments, become a big boy or a big girl, put your big girl pants on. Even if you're an everyday investor, how do you go from being an everyday investor to really, really becoming the person that you know that you want to be, which is a real estate investor and playing this game like the big boys do? I want to help you do that. That's what I'm doing, and I'm here for you. All right. So have a great day today. Let's get after it. If you love it, let's go. Boom. Are you an accredited investor with 300,000 or more liquid in the bank? I want you to come and partner with me. Look, if you love real estate, passive income, and positive cash flow, appreciation over long periods of time, and you're willing to be patient, come invest with me. Go to bell-capital.com. This is for accredited investors with 300,000 or more in the bank, ready to go. Come invest with me. Go to bell-capital.com.